So I think hard assets like that, commodities are going to do better relative to equities, relative to stocks. Gold's going to do great.
Economic data has shown that the key marginal driver to U.S. consumer spending, GDP, and tax receipts has been U.S. stock prices, not activity in the real economy. Therefore, can we infer that there is some silent government mandate to do anything and everything necessary to keep the stock market elevated?
Well, they can try, but they're not going to be successful. And I say this with the facts on my side of recent history, because as you well remember, in 2007, we had the meltdown in the market from October into March of 2009, and the Fed did everything it possibly could to stem it. I mean, they were cutting interest rates the whole way down. They were trying to inject liquidity into the market, and guess what? Stocks still fell 55%. They can try, but when psychology runs things as it does, it will naturally play itself out. And when the trend is done, the trend is done, no matter what the Fed can do. So people say, "Oh, the Fed's not going to let the market do this, or it's going to keep the market from doing that, or lift the market." But the market's the market, and the Fed didn't stop it in 2007 to 2009. It didn't stop it from 2000 to 2002. NASDAQ crashed 78%. Didn't stop it in 1929, although they didn't have the types of institutions they do maybe now. But recent history shows us that they're just going to be following the trend. They're going to be quote unquote impotent. But when the trend's ready to turn, the Fed will be there, and people will credit it as somehow stopping the move or something.
So, are you anticipating as this part of the trend changes, and liquidity dries up and the mood changes, et cetera, are you expecting the Fed to print massive historical amounts of money here to try to save it?
Yeah, can there be hyperinflation? Yeah, I think so. I'm not sure we thought that several years ago, but seeing what they did with the QEs, I think the possibility of hyperinflation exists. And in that type of environment, boy, gold is golden. You need to own hard assets. And, I was looking at commodity. We wrote commodities up, the commodity sector in our September issue, because something really interesting was happening. And that is, commodities had a big run up from 2020 up to 2022. I think they rallied 125% in the Bloomberg Commodity Index. And then they retraced about 55% of that last week or so. But managed money accounts, traders and futures were record net short commodities. So we had a 55% retracement of a rally, but managed money accounts just were super, super bearish. And to us, that's an extreme. So I think hard assets like that, commodities, are going to do better relative to equities, relative to stocks. Gold's going to do great. And those are the types of assets you want, as well as maybe short-term T-bills or things of that nature where you can get in and out very quickly.
So we're going to have some questions here on gold. I got a question first on basically globalization. The world economy, it's been an economic globalization for decades. Post the pandemic, though, and the Russian invasion of Ukraine, it seems like all that has changed. Are we going to witness, in your estimation, an increase in tensions around the world from a perspective of trade here? And, what is your analysis pointing to?
Yeah, that's interesting, because when we talk about psychology, I mean, it's not only just U.S., but it's global in nature. And so when we go from an extreme optimism, extreme ebullience, and that mood starts to change and starts moving in the opposite direction, it starts getting a little bit more pessimistic. Well, that's when global tensions arise, wars break out, trade tariffs, things like that. So I fully expect when the market turns around and starts declining in a persistent manner, that all these bubbling up tensions and problems are really going to explode globally. We're starting to see it a little bit now. And I think the reason we're seeing it now is because if you look at the market in terms of real money, in terms of gold, like the Dow relative to gold, I mean, that peaked 25 years ago in 1999. You know, when the Dow was worth 44 ounces of gold at the time. Well, the Dow right now is worth about 16 ounces of gold, so it's down a considerable amount. And I think that that underlying trend, that bearish trend, is starting to manifest itself in what you're seeing in the world today.
Are you of the belief that we'll see a 1-to-1 ratio in the Dow to gold again?
I do. I do think we will see that. I'm not sure when, but I do think that's definitely a possibility.
Interesting. So, in your definition, what is financial herding? And do you see a financial herding scenario that concentrates into the precious metals occurring at some point, you know, maybe the next few months to few years?
Right. Well, herding is going on all the time. Whether whether an asset price is going up or going down, people are herding, and you know they're not sure about finance or what's going on, and so they look to their neighbor to see what he's doing, or they read headlines, you know, and so herding is occurring at all degrees of trend all the time. And the question is, does it get to an excess? You know, is gold at an excess right now? And I think maybe short term you could say, yeah, we maybe had a nice little run up, and they could get a correction here for whatever month or 2 months or into the new year, whatever it takes. But I don't think the larger trend is over. And I don't think we've gotten to the excesses that we've got. Now, you're starting to see a little bit short term. For example, there's been a lot of articles recently how, you know, people are flocking to buy gold at Costco.
Mm-hmm.
And things of this nature. But those aren't the big signs that say you're at a gold top. You'll know it when you're at a gold top, because gold and silver tend to go pretty parabolic at the end of their moves. If you remember back in 1980 and so forth, and we're nowhere near that yet. So we're still pretty bullish on gold. We really started pounding the table when it was at $1,800. We're at what, $2,600 right now. So had a nice run. In fact, gold this year I think is up about 30% or so. It's outperformed the Nasdaq. It's outperformed the Dow. It's outperformed the S&P. So gold is probably one of the best performing assets. It is one of the best performing assets this year. And the mining indexes like the Bugs Index, HUI, I think is up even more so than bullion prices. So it's been a very strong sector. Wouldn't surprise me to see a short-term pullback here, but I think that would be an opportunity for those who want to be bullish on the metal.
Yeah, so you mentioned that 30% that gold is up. It's interesting because that's exactly where I was going with my next question. Gold's decisively broken out. It's up 30% almost this year. What is the big gold breakout telling you?
I think it's telling us that people are looking for hard assets. It's the same thing as interest rates shooting up when the Fed cuts by 50 basis points. People are looking at the market, and they're sensing that something's not right. And that something is just has been a mania for shares, relative to anything else. And so I think people are starting to look at hard assets as a way to protect their wealth if something does happen. And I do think that that's something, whatever it is, I think the psychology of the market tells you we're setting ourselves up for that event.
So you see an increasing probability of a black swan of some type, whether that be political, social, financial.
Yeah,
market.
right. Well, what the wave structure, the patterns are telling us is we're at the end of this bull market. And so these black swan events will occur as the trend changes from extreme optimism and starts moving in the opposite direction. So yeah, I mean, it's just a natural event, a natural manifestation of a change in mood will be these quote black swan events that will start popping up.
So, Stephen, in a recent X post, your company shared the following. The April and June issues of the Elliott Wave financial forecast discuss the large bullish potential for gold. Besides the developing wave structure, we cited the lack of gold holdings by ETFs, which usually line up with the rise and decline of gold prices. Would you speak into that for us?
Yeah, what's interesting is that if you look at the gold holdings in terms of tonnage or whatever by these exchange traded funds, they typically trend in reverse with gold. And as gold has took off over the last several years, these exchange traded funds haven't really increased their holding. Now, over the past several weeks to a month, they've started buying gold again and increasing their holdings. So that's another aspect of why we think the gold move isn't over, because I think as these exchange traded funds come in and start increase their holdings, gold will continue to rally and they'll eventually catch up. Another interesting aspect is that if you look at the open interest in gold futures, it has not expanded to the degree of prior bull market periods in gold. In other words, people aren't opening contracts, option contracts, and futures contracts to take advantage of a movement in gold, and that's another telltale sign that the movement in gold probably has much more to go, because I think toward the end of it, or as we get to a top, you're going to see explosion in open interest as people get interested in opening contracts to speculate on gold.
It's a great point. So silver tracks gold adjusted for CPI almost perfectly, especially since the early 2000s. In your analysis, what do you see ahead for silver?
Yeah, if you look back over since 2000, when it peaked in 2011, and it was probably the worst performing asset of any asset out there until a couple of years ago. So, in order for silver to realign and catch up with gold, it's really going to have a tremendous move to the upside. So, the old high was what, 49.90, $50 an ounce. I could see it, spiking well past that as this bull market gets going and it starts picking up, because it's relatively undervalued compared to the rest of the metals markets. So it's another interesting asset that you might want to consider owning.
So silver has historically lagged gold and has marked the end of the precious metal cycle with that huge blow off parabolic move at the end. It's an 8 to 10 to 12-month move. It blows off hard, and then the cycle seems to come to an abrupt end for both metals. Why do you see that happening in that fashion? Do you see that happening this time? And if that does mark the end and we're nowhere near the end, how far out is that big move for silver?
Yeah, it's difficult to put a time on it, because what we're really looking at is the form of the move. That's what Elliott waves are. And so we know it's at an end when the form is at the end, wherever that may be. But historically, you just look at the end of these big moves and they all end in these giant, like you say, parabolic spikes into a top or even into a bottom. And so, just when that occurs, you'll see it. You'll see, oh, silver's going vertical parabolic now. Now trying to pick the end of that, it's almost impossible. But it's a telltale sign that you're getting along, and we're not there. We're certainly not anywhere near there right now.
Someone had said to me in a previous interview that when we start going parabolic, the inflation adjusted number here, we're really not that high. So $50 inflation adjusted, I mean, it's still a very low number. And when you get to the top, normally, you have people who are trading in their silverware, and they're doing everything to capture that final big number there. But who's going to be trading in their silverware to get $50? Right. So what's the number now, inflation adjusted in today's dollars? What's the number now that is going to mark this end of the cycle?
Yeah, it's going to be well north of that. I'm not sure I can give you a number. Like I said, I'm looking for the pattern, the form of the advance. I'm looking for what we call a 5-wave rally, because at the end of that 5th wave tells us we're at the end of the trend. And right now we're in the third wave at 1 degree of that rally. So it tells us when we're not at the end of the third wave. So we still have to go through the third wave, have a fourth wave correction, and then go up again in a fifth wave. So we're still a ways away from that ultimate point where you're going to go parabolic, and you'll see that.
So, Stephen, while oil has edged up recently as Mideast tensions have risen, the price of oil has remained low for quite some time, relatively speaking. This is while the price of gold has remained elevated. So, aside from the gold miner balance sheets improving, are you seeing something in the technicals leading you to believe a big move in the miners is coming straight ahead?
Yeah, I think the miners are going to play catch up also. Like I said, the Bugs Index actually has outperformed gold bullion this year. XAU's up pretty big too. I think a lot of these mining stocks are going to benefit from this move. And they've been beaten down so much over the years. So it's going to take a while for them to catch up. The only caveat I would say is that when a bear market does start and starts moving down precipitously in a persistent manner, usually there's a period of time when all stocks go down, all correlations go to one. And so you have to understand that period is going to come, but these stocks are going to hold up much, much better than the rest of the market, which is way overvalued relative to the underlying asset values of their companies.
And obviously, during the Great Depression, the longer it went on, the main mining stock all of a sudden, it's eluding me. It went
Homestake
parabolic.
mining.
Homestake mining.
Yes.
So while the market dropped 89%, homestake mining was up something like 600%, and their dividend shot up from like $2 to something like $59. And so those, you had 25% of the people out of work, they lost their savings. 89% of the market declined. They lost everything. But if they had money in homestake mining, they actually not only were they spared, they actually were wealthy.
Right. Part of that was because gold was had a fixed price at that point. So it couldn't go down. So here you had everything else deflating around you, and then you had an asset whose price was fixed. And we don't have that right now, but I still think that relative to NVIDIA and those types of stocks have gotten way ahead of themselves. Yeah, there's no question that AI technology is going to be the future, but you've now priced in the future in these stock prices that are unsustainable. It was like RCA back in the 1920s. Television was a future, but you had priced in the entire future into the price of stock in 1929, and it took years and years before that stock price came back, even though television was an explosive success for the U.S. and the world. And AI will be a success, but the share prices of these stocks have gotten way ahead of themselves. So I got off tangent here a little bit, but I wanted to say that gold mining stocks are really an interesting place to look at right now.
So to your point, though, I mean, back in 2000, even Amazon and Microsoft dropped something like 70 and 93%,
exactly,
respectively. So even though the internet was the future,
yep,
and the way Amazon was going to sell to the world was the future, they dropped from around $100 to around $6, and it took about 14 years for them to come back to that 100. Now, of course, they took off and went way beyond that, but all of that to your point.
Right. And that's going to happen to these AI stocks. In fact, it already has started. I mean, if you look at everything but NVIDIA, a lot of MicroStrategy, a lot of these other stocks are way down from their highs. So, like I said, somebody, I can't remember who said it, but they said that the difference between a great company and a great stock is the price you pay. And it's so true, because you can't, these might be great companies, but their share prices are way out of line with what their earnings streams are going to be. So we would definitely be staying away from the AI sector now. In fact, I think it's topped out, and I think safety really is the key here.
So there are many charts showing stocks being historically overpriced relative to commodities. What's your technical analysis pointing to here?
Yeah, exactly. In fact, we ran that chart in the latest issue of the Elliott Wave Financial Forecast, and I think there's going to be a sea change where the relative value of commodities is going to increase versus stocks. I mean, it's been a one-way street. I think that trend has actually peaked out, and we're in the process of moving where hard assets and commodities are going to do better relative to equities. And that's the place we want to be right now, I think. And I just mentioned that money managers are record bearish, or they were several weeks ago, record bearish commodity stocks. And to us, that's an extreme. That's what we're looking for in psychology, both on the upside and the downside. So on one aspect, you have it on the upside in equities, and the other aspect, you have it on the downside in commodities.
So if you were advising some folks here, for the next 5 to 10 years on why they should be paying strict attention to natural resources, precious metals right now, what would you tell them?
I would tell them that you want to be safe. I think the word is safety going forward. And anything that I think gives you value and safety is something that you want to be looking at for your own situation. Everyone's situation is different, and I can't get into specifics with each person, obviously, but just as a general statement, you want to look for safety, and safety in terms of liquidity of your money, being able to get it. You want assets that are going to hold their value over time. Obviously, gold is one that has shown us over thousands of years that it's true money, it's real money. And things associated with gold like silver and such of those assets. Some other things that we've been saying that you should look at is maybe a 2-year floating rate note, which will give you kind of the same yield as a 3-month treasury, but it won't bounce around as much. But all of these things have their theme as safety. And I think if you're safe, or as safe as you can be going forward, you're going to have liquid assets and money to step in and buy stuff 10 cents on the dollar in the future that you wouldn't be able to do right now if you just have your entire IRA portfolio 100% in stocks, and your 401ks are all in stocks. And some people say, oh, I have some mutual funds. Like that's not stocks. I mean, you're all in stocks. You've really got to be conscious of where you are at this point in the cycle.
So, Stephen, how would you describe Elliott Wave analysis as providing an edge to investors?
Well, the real key edge is that we go to the true fundamentals of the market. Some people think the fundamentals are earnings or such, or GDP statements or Fed action, but the true fundamentals of the market are us, our human beings, and our interactions, and how that psychology of interacting manifests itself in the actions we take. So like we said, social mood precedes social action. And if you can see where we are within the progression of this mood, which is governed by something that we call the wave principle, this fractal pattern, if you can see where we are, it gives you an edge, because you can see around the next corner what the probabilities are. We don't know no one knows the future, but we can probabilistically predict the tenor of what is going to occur. And that gives, and that's all you really need to get an edge in the market. Is you don't have to be perfect, but you just have to have that one edge over the person next to you. And I think that's what the Elliott Wave model and what socionomics does, the study of social mood does for investors.
This has been a wonderful conversation. So before we wrap up here, and I ask Stephen our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Stephen as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. It's now time for our Golden Nuggets segment. Stephen, let's discuss portfolio positioning. You've talked a little bit about this throughout. Understanding you're not a financial advisor, and based on all that we've discussed today, and with your experience and your worldview as your backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
Well, the ones I want to stay away from are easy. Those are the ones that have had tremendous run-ups up to now, which are equities. And what I want to look at is maybe 3 to 6 month treasury bills. You can get almost 5% yield. We've been advocating those for several years now. 2-year floating rate notes, which will give you the same amount of yield. Those are 3 really good short-term safe investments. Your portfolio probably want to look at owning some gold, some silver. You'll have to decide how much of your portfolio you want. But again, the one word I keep coming back to is safety, safety, safety. If you can be safe in your assets at this point within the cycle, I think a year from now to 2 years from now, you're going to look back and go, boy, that was one of the best things that I've ever done for my portfolio, because I now have money to dive into whatever looks cheap at that point in time.
Yeah, I appreciate all of that. Thank you for sharing that. So, Stephen, thank you for coming on to Metals and Miners and for being so generous with your time and analysis and ideas. It's really been awesome to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
Yeah, well, you can come to our website, which is www.elliottwave.com. There's 2 L's and 2 T's in Elliott Wave. It's one word. And for people who are watching the podcast right now, we put together a special web page, a landing page. It's www.elliottwave.com/metals miners. elliottwave.com/metals miners. And we give away free articles, and you can look at our product, which is the Elliott Wave Financial Forecast. Elliott Wave Theorist is written by Bob Prechter. There's tons of stuff on our website, but that's the place to go. elliottwave.com, metals miners, and you'll see a ton of material that you might be interested in, and give us a check out and see if it's something you might like.
Yeah, I really appreciate that. And, I've been following you all for, I don't even know how long it's been, probably 18 months now. You guys have been a wealth of information and a great perspective. If you're not following them, guys, you really need to get on to Twitter and X. The information is there on the screen. I'm going to put all the information that you just shared up on the screen. There'll be links in the description area that you folks can click through. And, well, this has just been wonderful. I look forward to having you back on, Stephen, and thank you for being here with us. And everybody else, thank you for watching.
Thanks, Gary. Appreciate it.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.